Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today we're discussing payroll record-keeping requirements for small and medium-sized businesses. Why should you keep good records? Beyond the fact that they're required, keeping good records saves you money. Employers are far more likely to win under an IRS audit or in the tax court if good documentation is kept. Good documentation also protects employers against unjustified unemployment benefit claims by former employees, and you're also more likely to defend yourself in a workers' compensation insurance lawsuit if you have good records to support your side of the story. So what records should you keep? In each employee's permanent file, you should keep their hiring documents, other important documents, and copies of their weekly timesheets or time cards. Separately, you need to keep proof of payments for tax deposits as well as for wages, and copies of tax reports that have previously been filed, as well as a payroll register for each pay period and a copy of your payroll journal. For each new employee who is hired, you are required to have them fill out a federal Form W-4 and a state Form W-4. Most employees will generally claim between 0 to 2 exemptions, and you must withhold from their wages based upon their W-4s on file. New employees must also fill out U.S. Citizenship and Immigration Services Form I-9, which is available at uscis.gov, and must be able to prove they can legally work in the United States. Illinois Department of Employment Security also requires a new hire reporting form to be completed for each new employee and submitted with the department within 20 days from their hiring date. Copies of the form also must be available upon request. The U.S. Department of Labor as well as state departments of labor have various additional record-keeping requirements largely designed to protect employees against discrimination or not being paid proper overtime wages. The IRS also has its own separate record-keeping requirements, largely designed to ensure that employers are remitting the correct amount of tax. In a typical payroll system, workers will fill out a weekly timesheet reporting their hours, both when they punch in and out for their shift, as well as in and out for their various breaks and lunches. This form should then be submitted daily or weekly to their employer to be signed off on. This ensures that they're paid for their proper amount of overtime and that they are getting their required breaks. Employers need to keep copies of canceled checks and signed cash receipts showing payments made to taxing authorities as well as to employees. These payments should reconcile with your bank statement and show up as canceled checks on your bank reconciliation. Most employers also keep a variation of the payroll register on the screen, which shows the withholding done for each employee, as well as how they were paid and when. This needs to be done each pay period. Numbers from the payroll register will then flow into the payroll journal entries, both to record payroll for the particular pay period, as well as to record the employer's payroll tax expense. Employers also must submit quarterly or annual tax returns. Copies of these should be kept with the employer and should be made available upon request. Employers are encouraged to keep their records for at least 4 years from the due date, even after you close your business, although you may wish to keep records slightly longer than that, and they should be sorted by year. Forms W-4 should be renewed each year for all employees. Keeping good records saves you money, and protects your business. You should create an employment file for each employee and save all necessary documents for at least 4 years. If you need help with payroll, call us at AA Accounting. Our payroll experts have decades of combined experience. We can help you. Call us today to set up an appointment.